Hi, Gabriel Josiah here. All right, again, we're looking at in this session another financial metric. We are diving into the debt ratio. Debt ratio, a powerful financial tool that every accountant and business leader should master. By the end of this session, you understand not just the formula, but also its real world implication, causes, and effects, turning you into a problem solving wizard in the workplace. Let's unravel the numbers and decode the strategy behind the debt ratio. This powerful ratio is a game changer in the finance world. So let me quickly share my screen as is our custom, and let's look graphically into this fantastic metric or financial tool, which is the debt ratio. Okay, I've got mini me now. All right. So it's a financial metric that indicates the proportion of a company's total assets that are financed through debt. So the capital injection, or the asset composition of the company, or we call it the capital employed of the company. We want to see the composition of debt from those capital employed in form of total assets of the company. So what's the debt component on the total assets of the company? That's exactly what this means. This ratio helps assess a company's financial leverage and stability by showing how much its assets are funded by liabilities. Very, very important. The higher ratio suggests greater financial risk, as a larger proportion of the company's assets is financed through debt. So the formula is clear on the screen. We have it as total liabilities divided by our total assets, where we have the total liabilities inclusive of current and long-term liabilities, and the total assets refers to the total resources pool, which includes the current and the fixed assets, or the non-current assets. So the current and the non-current assets are the total assets of company. Okay, so let's use our example, Sharable 2, to calculate this ratio very, very graphically. Okay, so let's first have our total liabilities, which includes our non-current liabilities, and we have the total at the end of the year. Don't forget you're picking at the end of the year, which is 500 million. So let's take that. If you have your calculator and your pen, follow me closely as we do this calculation. So our total current liability, total non-current, I beg your pardon, our total non-current liabilities is 500 million naira. So let's go pick our total current. We have our total non-current liabilities. So let's go pick our total current liabilities, which is 400 million naira. So let's have that also added. We have it as our total current liabilities, which is 400 million naira. So our total liabilities is 900 million naira. Okay, so let's look at the second component, which is our total asset. Our total asset, which composes or comprises of our current and our non-current. Non-current, which is the traditional fixed assets, as we usually call it. Okay, so our total assets, which is a composition of the current, our current assets is 1,045 million naira. And we have total non-current assets as 550 million. So 550 million plus 1,045 million gives us a total asset of 1,595 million naira. So we'll pick that, come here and add it as our total assets. Our total assets. So now let's calculate our debt ratio. Our debt ratio is our total liabilities divided by our total asset expressed as a percentage. We have it as 56% of our total assets belongs to debt. So 56% of the 100% total assets is our debt, or is financed through debt. And so what does this mean? What does this mean? It means the debt ratio provides insight into a company's financial leverage, revealing how much of its asset base is funded by debt. So 56% in Shalobutu's case is the debt funded by the assets, or the asset funded by debt. So 56% of our asset belongs to debt. So 44% is left for the internally providers of capital, or the shareholders of the company. So a higher ratio indicates that a significant portion of assets is financed through liabilities, while a lower ratio suggests a more conservative financial approach to less reliance on debt. So in my opinion, 56% is a bit reasonable, though a threshold of 50% and low, in my opinion, is satisfying depending on the industry and the expansion strategy of the company. 56% debt in relation to assets is reasonable if it's justifiable, and a lot of returns as a result of expansion and other programs the company have are justifiable. So a high ratio above 56, 60, 70, 80 is risky, in my opinion, and generally for the business. So a more conservative approach to financing should be 50% and below. Not too high, not too low. And the word balance, like I keep reiterating, is key to ensure that a conservative financing approach is employed, culminating in less reliance on debt. Very important. Okay, so the implication is that a high debt ratio implies a higher financial risk, as the company may face challenges in meeting its debt obligations, principal and interest, don't forget, especially in economic downturns. Investors and creditors may view a high ratio as a sign of potential instability. Conversely, a low debt ratio indicates a more secure financial position, which may be more appealing to investors seeking lower risk. So investors are keen on a company having a low debt ratio, because it shows that if they invest their funds, their equity is safe, and the returns to generate is much more secured in their opinion, which is a normal business sense. All right, so what are the cause and effect? A high debt ratio is caused by aggressive borrowing for expansion, which is key to foster growth, high levels of existing debt, or a relative low asset base. While the effects is that it increases financial vulnerability, potential cash flow issues, and challenges in securing additional financing. So these are the effects, it's critical. While a low debt financing or a low debt ratio causes includes conservative borrowing practices, high equity financing, or growth in asset value without corresponding debt. Effects include greater financial stability, lower risk of insolvency, but potential missed opportunities for leveraging debt to fuel growth. Okay, so in conclusion, the debt ratio is an essential measure of evaluating a company's financial structure and risk profile. By assessing the proportion of total liabilities to total assets, stakeholders can gauge the level of financial leverage a company employs. So balance. I keep reiterating, a balanced debt ratio is vital for ensuring long-term financial health, as it enables a company to effectively manage its obligations while pursuing growth opportunities. This is very, very important. Okay, and there you have it, a comprehensive breakdown of the debt ratio. Remember, understanding a company's financial leverage isn't just about numbers or number crunching. It's about making informed decisions that drive growth, manage risk. If you found this insightful, don't forget to like, share, and subscribe for more tips and practical applications tailored for students as well as finance professionals. Drop your thoughts and questions in the comments section below. I would love to hear from you. Let's continue this journey to financial mastery together. Let's keep learning, keep growing, and see you in the next video. Until then, bye for now.